All right, guys, welcome to another live stream. Welcome to another live stream. In today's video, we're going to talk about 3 common mistakes in modern day investing. These are the mistakes that I see. The mistakes that I often see, and it's more of the culture. It's more of the past way of investing, and I think if people change to these 3 things, I think they'll do a lot better than what they're doing now. Right? And this is more for, give me a second. I'm just trying to see if my volume's working. All right, cool. We're good. Yeah, so I think the way of investing today is kind of outdated. It's throw your money in an ETF, throw your money in a mutual fund, throw your money in a 401k. Now, for disclosure, this is not financial advice. This is my opinion, so this is just what I think, right? But yeah, I think the culture today in investing is put your money in a 401k, you work the 9 to 5 job, you put it in an ETF, you put it in a mutual fund, and then when you're 60, you'll have enough to retire and live happily ever after, right? And that's not the case for most people. When they retire, they have around 300,000 to 400,000 in their retirement account, and it's a good chunk of money. That money you can use it. Let's say if you retire at 60, most people, people typically live until like 75, 85. So maybe that's good enough for a standard, an average life, right? Somebody that just wants to chill at home, maybe doesn't want to do vacations. But today, most people, when they retire, they want a substantial amount of money that's going to bring them a good cash flow each month, and it's going to sustain the lifestyle that they want, which is typically a lot of vacations, going out, hanging out with friends, going out to eat, traveling here, traveling there, and so on and so forth, right? So yeah, so today we're going to go over the 3 mistakes that I see commonly, and that it's geared towards, I wouldn't say making money fast, because you don't want to make money fast, but I think there's a quicker way to do it than previous ways, right? The standard 401k investing, throw it in an ETF, and you're good to go, right? I think there's a better way, and we're going to go over it today. All right, number 1, I think people invest too little up front, right? I think people need to focus on getting a substantial amount of money first before they start investing. Now, what are you told to do normally? You're told to dollar cost average, invest a little bit each month, and over 20 to 30 years, you'll have a good pile of money if you put it in an ETF. And that works, right? If you want to play it safe, again, you'll have a total of 300,000 to 400,000 at the age 60 if you're putting $100 each month or $200 a month, and you'll be good with that method at that age, right? But most people want that money a little bit earlier, in their early 30s, their early 40s, and things like that. So I think the first mistake that people make is that they don't spend enough time storing money, I would say in their early 20s, to get a good amount of money saved up, so that way they can invest in a quality asset. Now, what's a good amount of money? I think most people, when they get a few $100, like when they first get turned on to investing, they may only have like a few $100, maybe a few $1,000, and they invest that. They invest in something that they just heard somebody talk about on social media, and then they end up losing all their money, and then they get turned off to investing. I think people should spend at least 2 to 3 years building up a good capital base, and making sure you have a solid chunk of capital before before you begin to invest. So for me, that amount is anywhere from 10,000 to 50,000. I think that's a good standard amount. 10,000 on the lower end, because I think in 2 to 3 years you can build up to 10 to 50,000. You could work your typical 9 to 5, and if that's not good enough, you know, you can pick up a side hustle on the weekend, or maybe after your 9 to 5 job, you can do Uber, right? You can work at a restaurant, whatever the case may be. But I think with a 9 to 5 job and a side hustle, you're able to save up 10 to 50,000 within 2 to 3 years. I think it's possible for most people. And then also what you could throw in there is cutting expenses. A lot of you have too much expenses that don't allow you to save up to that 10 to 50,000, right? I think if you could get to that 10 to 50,000 number, that's the first step. That's the major step. And I think that's the first mistake people make. They have a few $100, they invested in something that somebody promised them to give them 100x, and they end up losing all that money. They get turned off. So yeah, I think saving up to that 10 to 50,000 within 2 years, 2 to 3 years, I think is the first step that you need to do. Don't go ahead and invest in something random. Don't try to put a few $100 here, a few $1,000s there. Try to get to at least 10,000, between 10,000 and 50. Obviously, the higher the better. But I think that 10,000 to 50,000 number is realistic for most people. So do that, and that's the first step. Now, what this is going to do is it's going to allow you to, one, have a good capital base. And then two, since you saved up to a decent chunk of money, now you already switched your psyche to say, okay, I spent a lot of time building up to this 10,000 to 50,000, whatever the number is. I spent a lot of time building up to this number. I don't want to lose this money, right? Because you probably did Uber, you probably worked at a restaurant, you probably picked up additional hours. You probably cut down expenses to get to that number. Most people don't have $1,000 saved. So if you were able to save up to 10 to 50,000 in that range, you did a lot of sacrifice, right? So you're training your psyche to say, okay, I did a lot for this money and I don't want to lose it. So you kind of build that psyche up during that 2 to 3 year journey while you're saving that money up, right? So once you build that up, that's number one. Number two is you want to do some research as you're building up to that money, right? Because you don't want to have that money and not know what to do with it, or not have a viable investment to get into to deploy that money, right? You want something that's going to be a quality asset, something that when you put your money in, you're not worried about waking up the next morning and seeing your account at zero, right? And that's what most people do. You see it in stocks. People play with penny stocks. People play with meme coins. People play with NFTs. A lot of the quick, get rich quick stuff you don't want to invest in, right? Now, obviously, I like the crypto space, so I know there's some low market cap cryptos that can give you those gains. So I'm not talking about those. I'm more talking about those meme coins where you could potentially make some money, but you also are taking a lot of risk, right? So two is researching that viable investment, so that way once you saved up to that 10 to 50,000, now you have some place to put it, and you've done the research while you're saving up to that money, and you feel confident in the investment you're about to get into. And that's the main thing. Confidence is one of the main things you need in investing, because you're not going to want to put a lot of money in something you barely know about, right? Most people will save up to that 10 to 50,000. But since they didn't do the research, they don't believe that if they put it in whatever they're thinking about, they didn't put enough research into it, that it's not going to bring them back any returns. And worse, they think they're going to lose their money. So they just keep it in a savings account or a money market or whatever, some bonds, and it doesn't get them anywhere, right? So yeah, that's the second part. Now with this, I do recommend at this stage to pay for information. I always tell people pay for information. What's on YouTube is great, but if you want to get into stocks, if you want to get into crypto, there's a lot of newsletters out there that talk about the biggest trends. Right now, it's AI, blockchain. In the crypto space, you have a lot of hot L1s, L2s. There's different stuff that's out there, and you don't want to be looking for it yourself. You definitely want some help. So make sure you are paying for information. I've paid thousands of dollars, over $5,000 in newsletters, subscriptions to get me the information I need so I can have the confidence to take the money that I built up in step one and invest that. So that way I'm not worried about my investment. You're always going to be worried about your investment, but you want to make sure that you did enough research to where it's not keeping you up at night, right? So that's number two, right? Number one was build a big capital base, and two, doing the research, paying for information, so that way you have the quality asset. So you know which quality asset you're going to get into, and you want to do that within that 2 to 3 years. So as you're saving up to that, that $10,000 to $50,000 range, you want to do the research, because again, you don't want to spend another 2-3 years finding out what you're going to invest in. Right, the longest part is going to be saving up to the capital base. I think once people get there, they're kind of like 40 or 50% of the way there, and then that 30%, I would say I would allocate 30 to 35% to, the research part. That's a pretty significant part, and for what you invest in, you want to make sure it could at least get you a double or triple. This is an important portion of step two. You want to make sure whatever you're getting into has the potential to give you a double or triple. A double just means if I put $100 into an investment, I expect to get $200 back, right? If I put $100 into an investment and I'm expecting a triple, I expect to get $300 back. And I think there's a lot of plays out there that can give you those returns. You just need to look for them. And again, paying for information is going to help you, because y'all have experts that are in the field that can, give you some recommendations, not financial advice. Because a lot of these newsletters, it's not financial advice. It's just recommendations. It's not personalized advice, right? It's just their opinion. But again, they should be experts in the space. If you're paying quality money for that information, they should have some expertise in the space. So number three, after you've built the capital base, right, a good quality capital base. Two, you've done the research, so now you know where you're going to invest in. Three, and most of you might not like this, and this is where this deviates. These 3 steps deviate from the traditional investing. Again, this is not investing advice. This is just my opinion and what has worked for me and what I've seen has worked for other people that talk about money on YouTube. And they usually, so the third part, the third step is going all in your investment, right? You've built up the capital base. You've done the research. You know what you're going to invest in. You have confidence in that investment. And then 3, you are now going to go all in that investment. Now, most of you would say, oh, that's risky and things like that. In order to beat the standard time frame in which people retire, right, which is at 60, you need to take some risk, right? But step 2 is very important. doing the research, and having conviction in what you're investing in. So, for instance, right? Like you can eat, like let's say you had $30,000 and you had the option to invest in something like Nvidia or uh, a mutual fund, right? The mutual fund is probably going to give you 6 to 8% a year. So to double your money, you'll probably need, close to 10 years to double your money. Where Nvidia, it's at a $2.9 trillion market cap. I think $100 price, 120, or I think it's at around $100 right now. It's at a $2.9 trillion market cap. Maybe the ETF and the mutual fund is sitting at 10 to 20 trillion. Who knows? But you, or maybe a little bit less than that. But let's just say you have conviction in Nvidia, and you think AI is going to be around for a long time. Well, most likely, if you look at the landscape, a lot of the $1 trillion market cap companies are trading in the $400 to $500 range. Nvidia is the only one, well, one of the only ones that are trading like 100, and it might be sub 100 right now. I'm not sure. I didn't check the price. But, you may have, let's say you did your research and you say, I think in 2 to 3 years, this can go to $200, right? Well, now, instead of waiting 10 years to get the double in the ETF, you put all your money in Nvidia. Now, obviously, there's going to be a lot more fluctuation with a stock like Nvidia because it's one company. It's not 100 or 300 companies, but it's a solid company. And again, I'm not saying to invest in Nvidia. I'm just giving you an example, right? You have the option to choose between an individual stock or an ETF. ETF is going to give you a double in like 8 to 10 years, depending on what ETF you get into. And then the Nvidia will give you that 2 to 3 years, right? Maybe the chances of Nvidia not giving you that double, out of 100%, maybe it's 10 to 15%, right? But that's the risk you take. But you're in a quality asset, right? So it speeds up the time curve. Yes, you go all in on that one asset, but you speed up the time curve and you're comfortable with it because you did the research. And I think if you take that approach and you focus on the research part and you make sure that you're getting into a quality asset, you're not going to have a problem going all in on one play. Most people say you would diversify, and I think you should diversify. Again, I'm talking about for somebody in their 20s, maybe early 30s that doesn't have maybe like a family, or they're just starting off, right? They're in the beginning stages of their career. I think in order to beat that standard 60 years old retirement time frame, these are the type of risks that you need to take. And most people, the three mistakes that I see is, one, they don't invest with a sizable capital base because they don't take the time to build it up. Two, they don't do the research and they don't pay for information from experts. And then three, they don't go all in on their investment. And a lot of the times is because they don't believe in what they're investing in. So you need to believe what you're investing in. I know for me, the more I got confident in my what I was investing in, I was okay putting an extra 10, 20,000 into an investment. Or I was okay with going 40, 50K into an investment because I knew that I did the research and I was comfortable with the downside risk, right? I've never had an investment go to zero, right? Like I'd never, maybe, I've lost some money, but those were the times where I didn't really do enough research and I wasn't really leveraging an expert in that space to help me pick out the asset that I want to invest in. So, yeah, those are the three mistakes that I see people typically make. Not a sizable capital base to invest in. Two, they don't do the research. And three, they don't go all in Again, and this is typically in your I say your earlier years, 20s, early 30s, because it's easier to bounce back from a loss, right? Again, I think if you're using an expert, if you're doing your own research, I don't think that investment will go to zero, but I don't, I can't promise that, obviously, but I don't think you, I don't think you'll go bankrupt taking this approach, right? Now, maybe you can space it out too. Maybe you don't go all in on one investment, but two investments, right? Maybe you say, okay, I have $50,000. I have two assets that could potentially double or triple. I'm going to put 25,000 in each of those investments. And now you space it out. Maybe they're in two different sectors. Maybe you have the top two plays in two different sectors. Maybe you have like a semiconductor, and then maybe you have like a food chain company. And now you're still kind of diversified, but you're still allowing yourself a lot of upside because you're not in 100 different stocks, or you're not in a mutual fund that's just going to give you like 6 to 7%. So yeah, I think those are the main mistakes that people make. I think if you do this, I think it'd be easy to grow 10 to 50,000 to 250 to 260 within 3 to 5 years. I think you'd be able to do that. Obviously, maybe a little bit longer, or maybe like I said, so if we take a 10-year time frame, that it would take you to double your money in like a mutual fund or ETF. Maybe you cut that down to 5 or 6 years, right? So it's not like we're saying get rich quick, you're going to get this overnight. It's still going to take you some years. Like, I don't think, maybe you get lucky with some plays that double within 6 to 7 months, but that's not going to happen often. You're going to need to be in a play at least 3 to 5 years to see a double or triple. That's a quality asset most of the time. Like I said, sometimes you do get lucky, you get a double or triple within the first 3 to 6 months, and then you could take that money and go again. So I think within 5 to 6 months, you could probably more than triple your money and speed up that typical time frame that it takes people to double their money, which is like 10 years with an ETF or a mutual fund. But yeah, that's my opinion. I think if you take this into consideration and use experts in the field that you're investing in, I think you'll go a lot further. All right, so that's pretty much it for me today. Some housekeeping items. Make sure you go follow me on TikTok, Financial Nutrition, Instagram, Mr. Financial Nutrition. I post Monday, Wednesday, Friday, and Sunday. Yeah, so also I haven't posted long form videos in a while. I've just been doing the live streams. So yeah, I like the live streams. I don't need to edit the live streams. You just come on, talk about whatever I want to talk about. It posts to the channel, but I do know, making long form videos and not cutting them up, just posting a long form video every now and then. I think I'll probably add to the schedule, but I don't know. I'll see what I want to do. Because right now, like I said, I'm doing the TikTok, I'm doing the Instagram, and I'm doing the live streams on YouTube. So I don't want to overstretch myself when I have a consistent schedule right now. But I do want to add a long form video into this. Like I said, I think it's going to come more towards next year when I'm able to take some capital out of the crypto market after the crypto bull run. And then I'm able to share maybe like a stock portfolio that I build up, and I'm able to share that with you guys. But that's pretty much it. I will see you guys in the next one. Take care.